You're self-employed. You took the leap. You built something real. And on a good month, you out earned half the people you know. So you walk into a bank to get a mortgage, fully expecting an easy yes. And instead, they look at you like you can barely afford to park. How does this happen? It comes down to one number on your tax return. And here's the twist that makes people furious. It's a number your accountant worked really hard to make as small as possible. Today I'm going to show you why the regular mortgage system quietly punishes self-employed people and the family of loans that fixes it. So you can buy a home using no tax returns at all. Let's get into it. Quick note before we dive in. I'm a licensed mortgage broker, and this is education, not financial advice for your exact situation. Loan terms vary by lender, and they change over time. So the numbers I use today are clean, round examples to make math easy to follow. Use this to understand how the pieces fit, and then talk to a licensed pro. That's what I'm here for, about your actual deal. So let's start with the good news. Being self-employed is a dream for a lot of people. You're the boss. You control your time, and the tax code actually rewards you for it. You get to write off your real business expenses, your vehicle, your equipment, your home office, your phone, and that lowers the income you pay on taxes. A good accountant treats that as the whole game. Their job is to make your taxable income as low as legally possible. So you keep more of your money, and when it comes to taxes, that's exactly what you want. But here's where it turns on you. When you apply for a normal mortgage, the bank does not look at the money your business actually brings in. It looks at the income you reported after all the write-offs, the net, not the gross. And it actually averages that net over your last 2 years of tax returns. So picture this. Your business brings in $200,000 a year. But after you write off everything you legally can, the bottom line on your tax return says you made, let's say, $65,000. To the IRS, you're a smart business owner who plays the game well. But to conventional underwriter, you are simply a person who makes $65,000 a year. Full stop. That 200,000 might as well not even exist. Do you see the trap? The exact same write-offs that saved you a fortune at tax time just torpedoed your mortgage. The better you are at lowering your taxable income, the less house the bank thinks you can afford. I have watched people who clearly make great money get denied. Not because they can't cover the payment, but because they were too good at taxes. And it punishes folks into two bad moves. Some stop taking their write-offs for a year or two, basically overpaying the IRS thousands of dollars just to look better on paper. Others throw up their hands and assume that being self-employed means they can't buy a home at all. But both of those are the wrong answer. Because there is a whole family of loans built for exactly the situation. Lenders call them non-QM loans. But please don't get hung up on that jargon. The simple idea behind every single one of them is this. Instead of judging you by your shrunken tax return, they qualify you on your real money, following through your life. And the star of the show, the one most self-employed buyers want, is the bank statement loan. A bank statement loan does exactly what it sounds like. Instead of asking for your tax returns and your W-2s, the lender asks for your bank statements, usually the last 12 or 24 months of them. They add up the deposits, the actual money landing in your account to figure out what you generally earn. No tax returns, no W-2s. They are looking at your true cash flow, the same cash flow you live on every month, instead of that shrunken number at the bottom of the tax return. Real quick, because this generally matters. If that just reframes something you've been banging your head against, do me one fast favor and tap that like button. And if you want more videos like this one, go ahead and hit the subscribe while you're at it. Here's the honest reason I asked. This channel is still small, and every single like and every subscribe is what tells YouTube to put this in front of the next self-employed person who got told no for the wrong reasons. It's free, it takes 1 second, and it is hands down the simple biggest thing you can do to help me making these videos. Okay, that's my one ask. Back to it. Let me show you the rest of the family and then the math. The bank statement loan is the main one, but it has cousins depending on how you get paid. If you're an independent contractor who gets a 1099, there are loans that qualify you straight off the 1099. If your accountant prepares a profit and loss statement for your business, there are P&L loans that lean on that instead. If you're sitting on a big pile of savings or retirement money, but you don't show income, there are asset-based loans that turn those assets into qualifying income. And if you're buying a rental rather than a home to live in, the property itself can qualify through a DSCR. Where the rent covers the payment and your personal income never comes up. I did a whole video on that one, and honestly, I cared enough about it that I wrote a book on it. It's called DSCR Loans Made Simple. It's on Amazon, in Kindle, and paperback. And it's the plain English playbook if you financing rentals where you're headed. The link is down in the description. Anyway, different doors, same big idea. You qualify on something real instead of a tax return. Let me make all of this concrete. Meet a self-employed buyer. Her business brings in around $240,000 a year, but after write-offs on her tax returns, they show about $70,000. She walks into a regular bank. They take that $70,000, call it roughly $5,800 a month, and after her car payment and her credit card is barely any room left in her debt-to-income ratio on the house she actually wants, they tell her no. Now she tries a bank statement loan instead. The lender pulls her last 12 months bank statements. The deposits average $20,000 a month coming in. Now they don't just hand her credit for all those. Now they don't just hand her credit for all of that because running a business has cost. So they apply an expense factor, often around 50%, to the accountant for what it takes to keep the business running. 50% of $20,000 is $10,000 a month in income to qualify. Look at the difference. The tax return said $5,800. The bank statements say $10,000. That is nearly double the income on the exact same person in the exact same year. And just like that, the house she wanted fits her numbers with room to spare. Same buyer, same money. The only thing that changed was which document the lender chose to read. Now, this is not a magic free pass. So let me keep you out of the potholes. A few honest trade-offs. First, the down payment is usually a little bigger. Where some conventional loans let a buyer in for 3 to 5% down, plan on something like 10 to 20% down on these. Second, the rate is usually a little bit higher than a plain vanilla conventional loan because the lender is doing more work and taking on a bit more risk. Think of it as the cost of being able to buy now instead of waiting years. And remember, you can often refinance into a conventional loan later once your tax returns catch up. Third, you'll generally want about 2 years of self-employed history, decent credit, usually in the mid 600s or better, and some reserves in the bank. And let me be crystal clear about one thing, because it matters. These are real regulated loans from real lenders. They are not the no document liar loans from 2008. You are still fully documented, your income. You're just doing it with bank statements instead of tax returns. So be honest on that application, because the whole thing works precisely because the deposits tell the truth. So let's put it all together. If you're self-employed, the regular mortgage system judges you on your net income after every write-off, which is the one number you spent all year trying to shrink. That is why good earners get declined. The fix is a whole family of loans led by bank statement loan that qualify you on your real cash flow instead of the no tax returns required. You'll usually put a bit more down and pay a slightly higher rate, but you get to keep your write-offs and still buy the home. You do not have to choose between saving on your taxes and owning a place on your own. Self-employed has never the disqualifier. The standard loan was just built for somebody else. And remember, this is education, not personal advice. So talk to a licensed pro about your exact situation. That's generally what I'm here for. Now, before you go, I want to ask you straight. If this video finally made the self-employed mortgage thing click for you, please hit that like button and subscribe to the channel. And I don't mean that as a throwaway line. This channel is still small, still growing, and every single like and every single subscribe is a signal that tells YouTube to show this to the next person who is making good money and still getting told for the wrong reason. That person might be somebody you know. So if I've earned it today, do me a favor, tap that like, hit the subscribe, leave a comment, and if you've got a question, and I'll see you in the next one.